The countdown is on. Everything you need to get the edge at the end of the market day. This is The Close.
A tariff deadline looms and markets swoon. Live from Studio 2 here at Bloomberg headquarters in New York, I'm Romaine Boston.
And I'm Sonali Basak. We are kicking you off to the closing bell here in the United States. And Romaine, we got a lot of red on the screen here. Let's take a look at where markets stand because we have an S&P 500 off of session lows, but pretty close to them. It's down by about 0.9%. And the pain is pretty broad-based across sectors. The NASDAQ 100 also down about 0.8%. Small caps feeling an even bigger pain. This is where there was a really large bid in recent weeks, so the pain is felt even greater. It's 1.5% lower. The Philadelphia Semiconductor Index, so even those AI tied names down about 1.8%, Romaine.
Absolutely. Another big test here, at least in the short term, of macroeconomic strength for this market ahead of Trump's July 9th deadline for trade deals or retaliatory tariffs. Remember that 4-day 13% plunge in the S&P after the April 2nd Liberation Day announcement? That gave way to a 90-day pause so nations would have time to negotiate with the U.S. 90 trade deals in 90 days. That's how the White House built it. And now the clock on those 90 days runs out in less than 36 hours without much progress. Now, in a nod to that lack of progress, the White House today did begin sending out letters to individual nations, starting with Japan and South Korea, giving them, at least those two nations, an extra 3 weeks until August 1st or face 25% non-sector tariffs. And that was not the letter that the market wanted to read.
I don't believe that all of these tariffs are going to go into place. And I certainly don't believe Korea or Japan is long for this world at 25%, no matter what happens. But those who think that this is all just a noise, I do think should pay a bit more close attention.
And the markets are paying attention. The S&P and NASDAQ near session lows. The EWJ Japan ETF that includes Toyota, Sony, Nintendo dropping the most since April 10th. And a main ETF that tracks South Korean stocks like Samsung and Hyundai plunging the most since August of 2024. Back here in the U.S., you got automotive stocks like Ford and GM sliding, as are chip stocks like Qualcomm and ARM. And that's putting a big dent, Sonali, in the risk-on rally that closed out the first half of this year.
Yeah, we are retreating now from session highs, and you can hear it from the way that these trade discussions are taking place. Remember, other nations that have already been sent letters include South Africa and Malaysia, as those letters keep coming out of the White House. Let's bring in Sean Donnan with Bloomberg News to break down all the change we are seeing, because, of course, it is coming fast and hard. We have some companies, or some countries, rather, Sean, that are seeing lower rates, but many that are seeing some that are actually higher. Where's the brunt of the pain?
Yeah, look, I mean, I think broadly this is in line with the April 2nd liberation tariffs that Donald Trump unveiled in the Rose Garden. Then, if you remember him holding up that big board, at that time, Japan was at 24%. The letter today came in at 25%. It's, we see a similar pattern with Korea, South Africa, Malaysia. They're all around the levels there. This is essentially Donald Trump, it seems, saying we're done negotiating and these tariffs are going to go into place August 1st. As we know, Donald Trump often likes to raise the heat before he gets some kind of deal. Yeah. We know that Japan and South Korea had officials negotiating with the U.S. through the long holiday weekend, and we're hopeful of getting somewhere. We haven't seen some other countries there that are interesting. India, a big economy in the European Union, that doesn't seem to be getting a letter. So, we'll see. But, we went into today expecting both letters and deals. Yeah. So far, we've only seen letters.
I am curious as to what the end game is. We're talking, Sean, right now about an average tariff rate in this nation that has more than doubled since he took office. And even if the base case tariffs go into effect, that number would go up even further. What are we negotiating here? Are we actually negotiating trade deals, the contours of what our trade relationship is going to be? Or are we simply negotiating what the tariff rate, what basically the payment these countries are going to basically be on the hook for, or at least more importantly, what we're going to be on the hook for if we continue buying stuff from them?
Yeah, look, based on these letters and what we've seen in the past almost 90 days, it looks like we're negotiating tariff levels. It feels like these are tariff deals, or that these letters are imposing tariffs. And when we think back to the UK as well, that was essentially a negotiation of a 10% baseline tariff, a significantly higher tariff than UK products had beforehand. The context for all of this is Donald Trump is putting a tariff wall up around the United States, and so far, as we've seen, that move from an average applied tariff rate of around 2.5% in January to somewhere around 15% today, possibly higher than 20% in the coming weeks. That's the biggest increase in U.S. tariffs we've seen since the 1930s, and we can't lose hold of that. That's going to come with economic consequences at some point. We haven't seen many of those yet, but we sure hear a lot from businesses who are starting to feel some pain.
Sean Donnan helps lead our economics and trade coverage there as we continue to await on more signals out of the Trump administration as to what comes next. As we watch the downdraft in U.S. equity markets, a big question as to whether credit markets are actually being affected by this at all. Winnie Cisar joins us now, global head of strategy at Creditsights. And Winnie, just before today, I was taking a close look at credit spreads, and there wasn't much spread there, about as tight as they've been, certainly in the 2000s. I think I had to go all the way back to 97 to find anything tighter than where we are right now. Any chance that those spreads start to widen?
Well, we hope that there's a chance, because we've been a bit cautious on the outlook for credit. Spreads widened out significantly in April, but I think that the pullback has been fast and furious and much sharper than a lot of people anticipated because of the strength of technicals. One thing that people got wrong in 2022 was the liquidity still in the system as the Fed began to hike rates. And I think that there's a lot of questions about how much liquidity is still there. And if there's still cash on the sidelines, should we be all buying credit because all-in yields are still quite attractive? Now, that dynamic does change when you start to introduce the conversation of a recession or economic slowdown or labor market weakening. And the reality is we just haven't seen enough of that concrete, fundamental negative impact yet. But it's still very much an evolving economy, both on the consumer side and on the tariff side.
Do you think that this is a market that has gotten comfortable with the idea of uncertainty? The narrative coming into this moment, Winnie, was that if you have an uncertain macro environment, then companies can't make decisions, yet you've seen companies kind of barrel through. Are the whipsawing of tariff rates okay as long as the economy holds up?
Yeah, I think it's a really interesting dynamic. I think that the market has gotten more comfortable with the current level of uncertainty compared to perhaps where we were in early April. It seems like most are expecting that tariff rates are going to be meaningfully lower than where they were going to be as announced on Liberation Day. But at the same time, we are seeing this divergence between the soft economic data, the survey-based economic data, and the realities of low unemployment rates, and still companies coming to the new issue markets and raising cash for whatever endeavor they're deciding to pursue. So I think that we are still all looking for more concrete evidence one way or the other that the economy is going to be fine, or perhaps we're going to have some sort of hiccup in the near term, and people are just not highly convinced as to which way things are going to break.
Do you have any conviction, Winnie, about the potential and, more importantly, the pace of Fed rate cuts?
Yeah, this is a tricky one. I think that my highest conviction is if the Fed is still on hold through the rest of this year, as we are generally expecting them to be, that may actually be the most bullish scenario for risk assets, as it would indicate that nothing has really shifted so dramatically in one way or the other that the Fed is reactive. Reactive Fed action is usually what you do not want to see in markets, because that means that they missed something, that they're behind the curve, that some sort of liquidity tripwire has been hit in the system, and they're having to re-stimulate very quickly. Now, as we get into the first half of 2026, it does seem like we'll have at least a little bit more time and more data under our belts to really assess the direction of the economy. How much momentum is the tax bill going to provide on both the consumer and corporate side of things, and how much disruption will tariffs actually have on the hard economic data. And that's the point where I think we could see the Fed perhaps being a bit more aggressive in their easing, as some of the labor market indicators, like a falling participation rate, are not generally a great leading indicator.
All right, Winnie, always great. Winnie Cisar, global head of strategy over at Creditsights, as we keep an eye on the market. And speaking of those potential Fed rate cuts, former New York Fed President Bill Dudley writing an op-ed today for Bloomberg, saying that rate cuts might not actually be the answer, and Trump's tariff wars are reducing foreign investors' appetite for Treasury debt. Dudley joins us after the break. Stick with us. This is At the Close on Bloomberg.
Now, the Trump administration's push for lower rates may have the opposite of its intended effect. That's according to former New York Fed President Bill Dudley, who argues in a new Bloomberg op-ed, warning it could force the Fed to keep rates higher for longer and push debt service costs higher over the long term. And if you look at this chart, this is also as interest payments balloon to more than $1 trillion. Let's bring in Bill Dudley now, because the chart alone says a lot, the direction of travel and the crowding out effect that it has. Now, the question is, as you pose it too, what do you do about it? How do you begin to bring this down when rates have remained so high?
So the Trump administration has said what we're going to do about it is we're going to job on the Fed. We're going to cut long-term debt issuance. We're going to move more of the debt issuance at the short end. And we're going to make it more, financial institutions, give them more incentive to buy Treasury debt by relaxing the supplemental leverage ratio. The problem with this is all these things are going to have very marginal effects. In fact, the pressure on the Fed is probably going to be counterproductive, because if it's a close call Fed, they're not going to cut as opposed to cut, because they don't want people to perceive their rate cut as being driven by the Trump administration, because that would basically reduce the Fed's credibility and could cause inflation expectations to become unanchored. Cutting, shifting the issuance from the long end to the short end, very small effects. Long-term rates are mainly driven by the expected path of future short-term rates. And same things with the supplemental leverage ratio. I mean, to really get interest rates down, what you have to do is something about the fiscal outlook. And the big, beautiful bill does not do anything positive in terms of the fiscal outlook. It adds about $3.5 trillion to the 10-year budget deficit. Obviously, if you get interest rate down, it would have a very powerful effect. 1% reduction in interest rates over the next 10 years would save you $3.5 trillion, about what the big, beautiful bill cost you. But pulling that off, in fact, is very, very difficult. I think what the Fed should do, what the administration should do, is, one, be more serious about fiscal consolidation. Number two, be more clear on what tariff policy is going to be, because I think that uncertainty ends up being embedded in higher bond yields. Stop attacking the Fed. That's just counterproductive. Doing more to improve the resiliency of the Treasury market. There's a bunch of things you could do to make the Treasury market more attractive. And if you did all those things, you'd probably have some positive effects on interest rates. But the fiscal thing is the biggest thing that they need to address.
I am curious, though, Bill. There's been a lot of discussions about some of the fiscal policies, as well as some of the policies coming directly out of the Treasury Department in terms of how it plans to issue debt, the shorter end duration of focus, as well as other statements that the Treasury Secretary has made that almost seems to suggest that the Fed's impact by using rates as a mechanism to steer the economy might not actually be as effective as it has been in the past.
I don't think that the Treasury can sort of undo what the Fed wants to accomplish by changing their Treasury issuance program. Maybe makes the Fed's job slightly more difficult. But at the end of the day, the Fed sets short rates, sets the path for short rates. That determines the path for long-term rates. That determines what's happening in the housing sector. It determines the valuation of equities versus bonds. So I think the Fed still has quite a bit of control. I think what's counterproductive
on that point, though, Bill, I'm sorry, if I can just interrupt, though, on that point, on the short end of the curve, though, I mean, if the Treasury does put more pressure with regards to short-term bills and the amount of the supply that's out there, meaning if they restrict that supply to a certain extent, does that not give them maybe some modicum of control of the short end of the curve?
Well, I think the short end is really based on where the Fed sets short-term interest rates. The market, I think, is tremendously elasticity. In other words, if you increase the supply of Treasury bills by $1 trillion. I think the market can absorb that quite easily. In the long end, I think, investors are much more segmented. So I think, if you take away issuance in the long end, it can have a bigger effect. So I think at the end of the day, the Fed sets the interest rate they pay on reserves. That sets all money market rates. I don't think Treasury debt issuance makes much difference. I mean, we've seen that over the last, 6 months when the debt limit was binding, right? Mm-hmm. Debt limit was binding. Treasury issuance was falling. Was less robust because of the binding debt limit. And haven't seen much effects on the yield curve.
I'm glad you brought up the big, beautiful bill, because there hasn't been a lot of discussion since it was passed regarding what the more immediate impacts will be. Is there anything inflationary about this bill to you, given the extent of the tax cuts? And do you see any other ramifications that are worth noting in the economy near term?
Well, I think the big thing is that the bill is going to add to fiscal stimulus in 2026, because a lot of the household tax cuts are front-loaded in the bill. Reductions of taxation on tips, overtime, Social Security, all those things are going to happen relatively quickly. The hard thing to figure out on the fiscal outlook is how much are the tariffs going to be offsetting the fiscals in the big, beautiful bill, because the tariff is not really included in the calculations that you see from the Congressional Budget Office.
All right, Bill, always appreciate you taking time for us. Bill Dudley there has a new column out on Bloomberg today. Of course, former New York Fed president, a closer look, Shonali, at where interest rates go next, and more importantly, who has control over where they go next.
Yeah, it's interesting. The 10-year has come down meaningfully since the heights earlier this year, but they have been drifting higher over the course of the past week, and it tells you a little bit about the anxiety that investors are still feeling.
Absolutely. Well, speaking of anxiety here, we're going to take a look at some of the big individual movers in the equities space, and that includes Crowdstrike. Those shares down after Piper Sandler cutting their call on the cyber stock. We're going to speak to the analyst behind it up next on The Close on Bloomberg. All right, let's get a view from the sell side with our top calls, big movers on the back of analyst recommendations, and we've got 3 valuation calls today. We start with Netflix, Seaport downgrading to neutral from buy. This after a 50% rally in the shares since early April. The analysts raising concern that Netflix has not grown its U.S. share, and the gap versus YouTube TV has widened. He also says investor expectations are high and it's time for management to deliver. The shares down 0.6%. Next up, MP Materials. Jefferies lowering its recommendation on the rare earth materials company to hold. The firm sees limited upside potential as the demand outlook remains mixed for some of its key markets. So shares down for a second straight day. And last up, Crowdstrike. Piper Sandler downgrading the software company to neutral. It's maintaining a price target of $505. Now, since Crowdstrike surpassed that price target, the analyst warns investors shouldn't be adding shares at this time as upside could be limited. Those shares down about 3% on the day, and those are some of our top calls as we stick with that last one and bring in the person behind that call. Rob Owens is co-head of technology research at Piper Sandler, and he joins us right now. Okay, I know this is a valuation call, Rob, but I wanted to talk to you a little bit more about what the potential upside could be for this stock. Where is the stability right now, and what potential upside do you see going forward?
Yeah, I think when you look at cyber in general, you definitely have a macro that's in favor here. Defensive related spending, not something that gets cut. However, when we look at CrowdStrike in particular, the stock's up, I believe, over the last 3 months, about 60%. You're looking at something that's over 20 times calendar 26 sales and over 70 times free cash flow. So, for us, the upside's limited. And we had both a base case and a bull case that was at $505. So, as the stock rallied last week and exceeded that target, we're encouraging investors not to add to positions at this time. So we lowered our rating to hold.
When we talk about the health of this company, or rather, I should say, the perception of this company, is the idea that that big outage that we had more than a year ago, I can't remember the exact month it was, more than a year ago, is that truly behind this company? Have they resolved that, not only with their investors, but more importantly with their customers?
Ironically, it was less than a year ago. It was actually at the end of July last year. So we're approaching the anniversary. I still think we're seeing a little bit of the fallout. I mean, if we look at the numbers, we probably cut expectations by about $225 million. We probably cut growth expectations 3 to 5% as a result. And they did have to make amends to their customers, and they rolled out various programs and gave away incremental product in effect, which in a lot of ways is discounting, but help with customer retention. So I think we're through a lot of the pain associated with that and some of the longer term potential effects, but it did impact the business.
Rob, I understand your point about the most recent run-up, but you look at Crowdstrike and it is up around 47% this year. By comparison, you look at Cloudflare and it's up 78% this year. Why wouldn't it just be that, okay, we're in a world where cyber incidents are coming fast and hard and more retail interest is being drawn into these stocks? Could you see an upside given the way that momentum is flowing?
I think given the way momentum is flowing, yes, you could potentially see upside to these names. And, there is a case where these things do get more expensive. But at 21 times, especially given 21 times sales, by the way, we're not talking cash flow, we're not talking earnings. And given effectively where the business is growing right now and some of the concessions that I mentioned earlier that they're making, growth is probably a low 20s type of number. And there's limited margin expansion as we move forward in our view. So, to that end, it's probably relatively fairly valued. Now, if we're talking about cyber longer term and some of the consolidation plays, a CrowdStrike, a Palo Alto, definitely are long-term winners in the space. But again, we upgraded the stock a little less than a year ago at $220 post-incident. And we think given the run to over $500 today, it's probably time to tap the brakes, not add to positions at this point, and look for any opportunities to frankly get more opportunistic around the name.
Rob, what do you like better?
What do we like better? Well, we just put out a preference list today, and number one is actually Fortinet into what we believe is a strong firewall cycle and a setup for the second half. We also have Atlassian and GitLab as our number 2 and 3 picks. And then continuing on with cyber, we have Checkpoint and SailPoint rounding out our top 5.
Rob, thank you so very much for joining us today. That
Thank
is
you.
Rob Owens, co-head of technology research at Piper Sandler and Company. And it's interesting, CrowdStrike was, Romaine, one of the companies that was engaged by Columbia University when data was stolen by a hacker.
Yeah.
So high-profile recent names. I'm sure when it comes down to it and all the new interest that's coming in, every time you're attached to a high-profile hack, there's new interest.
It's funny. He just mentioned a 20-plus price-to-sales ratio. I had to look that up. I mean, the great thing about having a Bloomberg terminal is you can run these functions pretty fast.
Your fingers.
That's insane. I mean, it's basically like the third highest. I mean, their current price to sales is the third highest in the S&P 500. And even on a forward basis, still the third highest. Palantir is really the only one higher than them. And some would argue maybe Palantir deserves it. And then you have Texas Pacific Land, which is number 2.
It's hard to deny. You look at, he's in Palo Alto Networks, for example, one of the other big companies that people are watching. But when people are thinking about defense being one of the biggest trades this year, cyber defense is part of that.
Yeah, absolutely.
Anyways, coming up, we're going to go macro. We're going to bring in Michelle Meyer. She's the chief economist at Mastercard Economics Institute. We're going to talk about the state of the consumer and retailers as we enter the second half of this year. Of course, on the wave of those fresh tariff rates, we're going to want to see what the consumers think. This is The Close on Bloomberg.
.30 p.m. here in New York. This is the countdown to The Close. I'm Romaine Bostick.
And I'm Sonali Basak, and we're looking at a tough day in the market, Romaine.
Yeah, a tough day in the market. Of course, a market that appears to be rattled by some of the latest tariff-related headlines. Of course, that July 9th deadline, less than 36 hours away, and we're pretty clear right now that most of the nations that were supposed to be involved in negotiations aren't going to meet that deadline. So our market's having to reckon with that.
They certainly are, and tariff rates changing under our feet. One set of clients, if you will, that have to grapple with this is just the U.S. consumer. And you're looking at sales. At Saks Fifth Avenue, for example, falling 16% during the quarter that ended in June from a year earlier, according to Bloomberg's second measure, which tracks debit and credit purchases. At the same time, sales at Bloomingdale's and Nordstrom both rose more than 10% during the same quarter. And if you guys don't know, these tend to be pricier types of purchases. Joining us to discuss more now is Michelle Meyer. She's chief economist at the Mastercard Economics Institute, and it's interesting to see such types of divergence. Of course, different retailers are going through different strategy changes right now, but in order to capture the U.S. consumer, the types of people who are willing to spend right now, what kinds of uncertainties are they still facing as they put that extra dollar to work?
Sure. So I think it's been a period of uncertainty, of heightened questions for consumers, for businesses, for policymakers since the start of the year, frankly. The headlines have come in fast and furious, and today's another example of that. But at the end of the day, I think what really is driving consumers is what they're seeing in terms of their finances, what they're seeing in terms of the labor market. And Friday's jobs report showed that stability is still here in the labor market. There's some changes in the sense of churn of the workforce is a little bit lower. We are seeing the hiring rate fall. We're seeing the quit rate fall. But generally speaking, we're still net adding jobs. We're still in an environment of a low unemployment rate. And we're still in an environment where wage growth is coming in pretty steady. So while there's headlines, while there's risks, I think the fundamentals have been actually remarkably stable.
So at the end of the day, even if the unemployment rate has been quite stable, there are still concerns that there could be a fall off when it comes to jobs. There's also concerns that payroll growth is slowing as well. At what point does that start to create a dent in what consumers are willing to spend?
So I think there's always the fear of the uncertainty that's out there. There's concern over the state of the labor market. There's concern over the health of the economy. We've seen that from surveys. And that could matter on the edges for certain households in the sense of, maybe there's a little bit more of an inclination for precautionary savings. There's a little bit more of a desire to get the best value, to make your dollars work the best in a world where you don't know necessarily what's around the corner. But we also very much know from the last several years that consumers are nimble. They adjust to the environment around them. And I think that they've done a very, very admirable job doing that in the last several months where the risks are there. There's lots of uncertainty, but at the end of the day, they're making decisions that work based off of the data they are working with at the moment, which is largely based off of what they're seeing in terms of trends of the workforce.
In terms of what you're seeing, though, Michelle, in terms of spending trends, are you still seeing healthy spending on discretionary items?
Yeah, we're seeing still a pretty mixed basket of spending. Now, part of, I think, what's helped is that gas prices are lower. So when it comes to essentials, consumers have a little bit more freedom to spend on some of those discretionaries if the price of essentials is easing or falling, particularly for gas. And I would argue that discretionary spending obviously is going to differ for each household, whether it's discretionary goods, certain big moments where, consumers will splurge, electronics, for example, new technology, areas where there's innovation always seem to be a big appeal. But even discretionary services, look at lodging spending. It's still trending pretty strong based off of what we could see. Spending at restaurants also trending at a pretty healthy clip. So I do think that consumers are out there engaging. They're doing it based off of what works best for them with, again, the information they have.
So let me just flip that question around, because obviously that's from the consumer's perspective. I am curious about from the perspective of the sellers, the retailers and service providers themselves. I mean, we talk about being on the eve of this new tariff regime. We're also on the eve of the Amazon Prime Days, plural. And it really raises a question as to how companies like Amazon, Walmart, other big retailers positions themselves for an environment that is still relatively uncertain.
Yeah, I mean, I think it's pretty remarkable what we see in the last few years where it's a lot about finding consumers where they are and making sure that consumers have that value. And these are these big promotional periods that are out here. Used to just be Black Friday. Now it's this extended pre-holiday period. And there's this kind of summer Black Friday that has come about. And I do think it really triggers consumers to engage when they feel like they have value and they're getting those promotions. In our own data, we looked at our spending pulse data for retail sales online, retail sales ex autos online over the last 3 years during this promotional period in the summer. Spending was 15% above the underlying level over the prior 4 weeks during this promotional period. So it really does highlight how consumers are going to choose to use their purchasing power when they feel like they're getting the best deal. And therefore, as a retailer, you want to be part of that. You want to be able to engage and figure out how consumers are going to choose you and to choose that item to use their consumer power.
Michelle, I want to ask how the macro might impact the reality on the ground for Americans, because you look at the dollar. for example, it is still hovering near its lows. It is down almost 9% if you're tracking the Bloomberg Dollar Index on the year. And you can make an argument here of whether we're on the brink of importing more inflation. Do you think that the U.S. is really at great risk of having a prolonged inflation spike, frankly, if we see the dollar remain at these levels?
So I would unpack that a little bit in the sense of a spike. I don't think we're on the cusp of a spike. I think it's more an adjustment that is now going to be underway for quite some time. And the dollar is one part of it, but the tariffs are even the bigger part of it, is that we know the cost of production is going to rise for a number of goods. Not everything, depending on those supply chains, depending on how the bilateral agreements end up with each country. But without a doubt, we will be seeing higher tariff rates, and therefore some of that will be shared with consumers. But it's a slow process, right? And I think that's what's taking a long time for the markets, and also for, some of the survey data as well, to realize is that you don't snap your fingers and tariffs show up in the economy because the headlines suggest they're coming. It takes time for that to actually be implemented and then for consumers to realize it. But I do think that's forthcoming.
Michelle, the other thing I want to ask about, too, is how companies are being impacted. Romaine was asking about retailers. What about big versus small? Recently in the markets, you've seen an investor bid back into the Russell 2000. You're seeing that index harder hit on a day like today. These companies tend to be more highly levered. Interest rates have remained high. Do you see them continuing to weather the storm as well as they had, or are they showing signs of stress?
Well, I think in general, at periods of economic stress, larger companies will overall tend to be better positioned because they have greater buffers, they have more cash on hand, they have access to capital markets, they usually potentially have more diversified business model. So I do think that's something to pay attention to and watch, but it really depends on the sector, and it depends on, frankly, how exposed each small business may be to tariffs. And this is not one size fits all when it comes to tariffs, as we're seeing very, very clearly. It depends on, as a small business, it's going to depend on what retail space you're in and who you're getting your supplies from, which country, and how well you can diversify.
All right, Michelle, always a great conversation. One of the best in the business, the chief economist at the Mastercard Economics Institute. Michelle Meyer, as we continue to keep an eye, Sonali, on the markets, and of course, that means an eye on the economy as well. I did my part to support the economy this weekend. I bought a new pair of shoes from Saks, of all places. Just still, looking forward to it. So.
I'm not going to disclose how much I spent this weekend.
Yeah,
that's what boredom does to me.
Okay, all right. Well, Sonali did her part as well. Meanwhile, we go back to the markets here, right around session lows for most of the major indices, and the biggest drag on the S&P and the Nasdaq right now is Tesla. Those shares down about 7%. This is CEO Elon Musk, who said he was done with politics, apparently getting back into it. We'll explain when we come back. It's our stock of the hour, and it's up next. This is Bloomberg. Time now for our stock of the hour, taking a look at shares of Tesla, nosediving after the CEO, Elon Musk, said he's going to form a new political party here in the United States called the, quote, America Party, and it plans to focus on the House and Senate races that are coming up next year. Investors a little bit of concern, of course, because Musk had recently said he was kind of out of politics, stepping away from the Trump administration in fiery fashion, and now apparently wading right back into it. Max Chafkin has been assigned the very envious task of covering things all Elon Musk here at Bloomberg. So you've been following this. I don't even know where to start with this. When we talk about a new political party, you can make an argument that, okay, probably a third party is maybe warranted in this country. But what's the rationale for Elon Musk doing this? Is it just spite because he didn't get what he wanted out of Trump?
It is hard to see a rationale where Elon Musk is working towards his own interests. It's true that when you ask Americans about the two political parties, you often hear sentiments of disapproval, but in practice, third parties have not done very well. The other thing is that what Musk is really proposing when you look at his policy positions is not a centrist third party. It is a far-right third party. It's a party that would be like further to the right of Donald Trump. I don't think it's clear that would would have a huge following. I mean, Musk would have to change a bunch of his positions, make them more popular, and then make himself more popular. Because over the past year, we've seen Musk's own sort of personal approval ratings just plummet. He went into the 2024 election as a popular guy, and he's become, basically an unpopular politician.
Max, call me a lazy student here, but why create a whole new political party? Why not just directly try to influence the midterms?
Yeah, and I think that is ultimately where this may lead. And Musk has said a lot of things. Musk says a lot of things on Twitter, some of which turn out to be what he does, some of which turn out to be essentially just trash talking. I think my baseline assumption here is that he's going to fund a handful of candidates in the midterm and try to exert influence that way. Even then, though, I think it's going to be hard because Donald Trump has such a grip on the Republican Party. We saw this with mega donors in previous cycles where when they try to go against Trump, they tend to lose. And we're seeing that conflict now.
I do want to circle back to the company at hand because investors are upset about this, not because of any deep political beliefs, but the idea that this is just going to steal more of his attention, his mind share, away from actually running his company, at least the big publicly traded company has, forget SpaceX and everything else. And I am curious as to whether we have to start talking about maybe leadership change. If this is what he wants to do, who's going to be running Tesla?
You're starting to see that in very small ways among Tesla bulls who, to date, have been basically all in on Elon Musk. Even when they disagree with Elon Musk, even when they've been sort of vaguely horrified by things that Elon Musk has done, have sort of said, well, you got to give him credit. But what we're seeing now is a handful of bulls essentially saying the board needs to do something. They're not quite saying the board needs to fire him or threaten to fire him, but they are starting to try to push the board in that direction.
Well, certainly the pressure is on. Tesla shares really taking a beating, down more than 38% since the December highs. Now coming up, we're going to switch gears. We're going to take you to the closing bell with the head of strategic ETFs at ProShares. This is The Close on Bloomberg.
What the administration should do is, one, be more serious about fiscal consolidation. Number two, be more clear on what tariff policy is going to be, because I think that uncertainty ends up being embedded in higher bond yields. Stop attacking the Fed. That's just counterproductive. Doing more to improve the resiliency of the Treasury market. There's a bunch of things you could do to make the Treasury market more attractive. And if you did all those things, you'd probably have some positive effects on interest rate.
Former New York Fed President Bill Dudley kicking us off to the close just about 50 minutes ago, talking about his latest column on Bloomberg. Some big concerns here about where Fed rates go, and more importantly, what mechanisms are in place right now for the Fed to maybe blunt the impact of some of these fiscal decisions.
Yeah, and a lot of uncertainty, maybe a little more clarity on the fiscal with that big, beautiful bill, but not with tariffs. And you're seeing that uncertainty feed into the markets. You're looking at the S&P 500 off of session lows as we head closer to the close, but still down about 0.9%, and even more pain when you look at the tech-heavy indexes. NASDAQ 100 almost the same, but the Philadelphia Semiconductor Index down almost 2% this morning, or today, rather, this afternoon, and the Russell 2000 down about 1.6%. Pretty amazing moves here.
Yeah, I'm glad you put the Russell up there, because last week we were talking about the outperformance that we had seen by small caps, as a lot of people were starting to take a more positive view of the economy and the stocks in those indexes that would be affected by it. And of course, that's flipping now because of concerns about how trade might affect the bottom lines for some of those names. Mo Haghbin joins us right now. He's the head of strategic ETFs over at ProShares. Mo, great to have you here. We got to start off talking about trade, tariffs, this July 9th deadline, and more importantly, how consequential it could be for markets. Will it?
Yeah, well, look, thanks for having me. And I think just on the drive over here, things have changed, right? So it feels like it's a fast-moving space with, announcements on social media and announcements through various means. I think, the market has priced in a lot of good news. I think the negotiations and the extension to August 1 is really something that the market kind of expected. And a little bit of the noise today, I think, is around the announcements with Japan, South Korea, and some of those tariff levels that were probably a little bit unexpected and higher than people thought. I think overall, many still believe that the negotiations are going to happen, and there is a little bit of a taco kind of feeling out there that, you know, it's a lot of negotiation, but at the end of the day, we're going to find a way through some of the bigger trading partners.
Well, you hope so, because that's what was priced into the market. And I think the reaction today is that all of a sudden, when you see our 25 in Japan is South Korea, and he announced a few other second nations like Myanmar, Laos, you're talking 30-40% tariff rates. That's much higher than that 10-15% baseline that I think a lot of people had. And it raises the question right now that if we do start to see the higher end of that tariff scale come in, what does the market do, and what does the market buy if they are going to buy something to protect themselves from that impact?
Yeah, well, look, I think a lot of that good news that's priced in exposes us to negative surprises, and it's a very headline-driven market. So if there are negative news implications from some of the negotiations, it will show up, and it will show up in equity prices. If you think about fundamentals, if you think about the greater macro picture, we have a slowing economy. We have certain things that we're not talking about that's not really priced in, and there is a lot of optimism right now. So I would say being a bit defensive, being up in quality, up in cap, maybe even a slight overweight to fixed income and alternatives at the moment is very, very prudent.
How much do the details matter? Because ultimately, we're talking about these tariffs like you can bring the rates down to some level that is not as scary as the ones we saw at the early April levels, and that could be okay. But then you look at the countries that we're talking about here, Japan, South Korea. Are they friends or are they enemies? Ultimately, these are major trading partners. Does the rhetoric matter at the end of the day, given the countries we're talking about are major auto exporters?
Right. Well, what I think it's showing us is that conventional wisdom around trade and policy is out the window. And I think for investors, what you need to be focused on is being nimble and being more tactical. What's going on here and now, I think trying to plan for 1, 3, 5, 10 years down the road is a really difficult thing.
We're trying to plan for 3 months down the road.
And I think we have to be a bit more nimble and tactical in our asset allocation. Many of the institutional clients I talked to today, they're hugging their policy benchmark. They're not taking a lot of risk. They want to be close to home, and they're not overextending in risk. And I think that's a function of what we're seeing. It's a reflection of some of the uncertainty on the policy side.
What do you feel about the direction of interest rates and how much it's going to matter to this market?
Yeah.
We walked in today, calm bond market. We've seen a drift higher in yields as we watch the day go by. Doesn't make a dent at the end of the day if you think that what investors are really worried about is inflation.
So I have a view on this. I think the market is pricing in two cuts by the end of the year. That's pretty optimistic. I think there has to be a catalyst for that. The Fed has a dual mandate. The unemployment or the employment, the labor market side of things is not showing significant cracks. I don't know why we would have aggressive Fed cutting from now until the end of the year. 2 are priced in from now until the end of the year. Another 2 in the first 6 months of next year. I think that's overly optimistic. I think there would have to be a significant stress in the labor markets or a significant event to get the Fed to start cutting rates.
You know, Mo, you're never going to get that Fed chair nomination with that type of
I'm not.
Right.
I'm not in the running.
But point taken. Yeah, it gets to the idea, though, too. I mean, with markets at basically record highs, we'll call it record highs from last week on the S&P and the NASDAQ 100, there's a lot of concern about how do you preserve those gains. There are some people, of course, would just say, okay, just sell your profits and take your profits and move on. But a lot of people either have to stay invested because of their mandates or want to stay invested. You guys introduced, I think it was back in June, right? Some buffer funds
Yes.
that, to a certain degree, is supposed to sort of provide you some upside potential, but more importantly, protect you from downside risk.
That's right. That's right. I think when I think about ways to get diversification or downside protection, there's 2 things that come to mind. One is, back to your point, Shanali, income that's not sensitive to interest rates, so think derivative income, is a great area to be focused on for investors. The other is downside protection, whether it's hedged equity or buffer strategies, which allow you to use options to reshape kind of risk and return in the portfolio. And remember, a lot of clients are tax sensitive, so buying and selling introduces short-term capital gains. So getting something that is more aligned to your risk tolerance and staying invested is a really, really good way of attacking an uncertain market, and our buffer strategies provide that.
All right, Mo, always appreciate it. One of the great minds got there in the space. Mo Haghbin is head of strategic ETS over at ProShares. And Shania, I kind of forgot. I was like trying to think of the word buffer, but that was a big. But it's actually an interesting concept, and ProShares isn't the only one to kind of start this idea. But the idea you could kind of take these more sophisticated option strategies and package them in a way that is a little bit more palatable for kind of everyday investors.
And we know that retail investors even are looking to get into more complex products, especially when they're not looking exactly to take on too much more risk. Hugging the benchmarks is what Mo says.
Absolutely. Well, right now, those benchmarks are near session lows, off session lows, but still down significantly on the day. The S&P down 0.8% and a big downdraft in the small and mid-cap stocks. A full breakdown starts right now.
The Closing Bell, Bloomberg's comprehensive cross-platform coverage of the U.S. market close starts right now.
And right now, we are 2 minutes away from the end of the trading day. Romaine Bostick alongside Sonali Basak, taking you through to that closing bell with the global simulcast. It starts. Tim Stenovic joins us in the radio booth. Emily Garfeo in today for Carol Massar. Welcome to our audiences across all of our Bloomberg platforms, including our partnership with YouTube, on a decidedly down day, Tim Stenovic, that seems to revolve around uncertainty about the U.S. trading relationship with the rest of the world.
We have certainty on Kazakhstan. We have certainty on Laos.
You went straight there.
We have certainty on Myanmar. We've got certainty on Malaysia, South Africa, Japan, and South Korea. Although, to be fair, maybe it's not certainty. Maybe those are just sort of opening salvos. That's what I'm trying to figure out. I think investors are trying to figure that out, too.
And investors today, they were selling stocks. They were also selling treasuries. I will point out, though, that the dollar index, the Bloomberg Dollar Spot Index, was higher today. So that dollar getting a little bit of a bid.
Yeah, I'm glad you brought up the dollar. It's becoming a talking point, isn't it? Because even though it's getting a big bid, it's still hovering near the lows of the year. And we're watching a worry here about whether there is an issue of importing inflation while this tariff strategy gets sorted out.
Yeah, and I just want to point out, too, just for our viewers and more importantly our readers on the Bloomberg terminal and Bloomberg.com, there is really a great tracker, basically a tariff tracker that we've done, because it's kind of hard to wrap your head around it. Tim, you were rattling off a few nations there. I mean, I couldn't even remember which countries were still in play.
I was looking at the live blog, though, to do that.
Yeah.
I mean, you can't remember this stuff. We spoke to the Trek CEO a little earlier. He said uncertain. I mean, he doesn't know what's going on. It's uncertain.
Yeah, no one does. And remember that a lot of the tariffs we're talking about today, these are those non-sectoral tariffs, basically the across-the-board ones. This doesn't necessarily impact those sectoral tariffs, the ones on autos, the ones on steel and aluminum, et cetera, et cetera. So a lot for investors to parse, and that's a big reason why a lot of investors may be looking for the door. The Dow Jones Industrial Average down more than 400 points, or 0.9%. The S&P down 49 points, or 0.8%. The NASDAQ Composite is going to close out the day down by 0.9%. And the big decliner on the day, that's the Russell 2000, a drop of 35 points, or 1.6%.
A decidedly down day, as you mentioned, Romaine, in the S&P 500. Only 96 of these stocks did move higher today. 404 were decliners.
Listen, we're looking at a broad-based decline as well in the S&P 500. Most major sectors were definitely in the red today, led down by consumer discretionary, which carries Tesla. So don't be too taken aback there, because we did see also very significant drops in materials, energy, financials, and communication services as well. Really only two sectors in the green: staples, a defensive trade, utilities. Got to still buy those picks and shovels, guys.
All right, well, speaking of buying, I was able to find a few stocks in the green today. The best performer on a percentage basis in the S&P 500 today, look at that. It's Tractor Supply, up 3.9%.
Oh, wow.
Rose today, the highest intraday level going back to April. This is thanks to data from Bloomberg's second measure. It says that adjusted sales observed by Bloomberg's second measure rose 4.3% in the second fiscal quarter. What Bloomberg's second measure does is it analyzes swipe data, mostly from debit cards, to get an understanding for how people are purchasing and what their consumer behavior is.
Yeah.
The data does draw from a sample of credit and debit card purchases made by U.S. consumers. Analysts currently estimate revenue for the quarter up about 3.6%.
Have you ever been in a Tractor Supply, Tim?
I have not been in a Tractor Supply. Where I grew up, there was like a local version of Tractor Supply called Farm Supply.
Okay.
So I used to go there all the time.
Interesting.
Yeah, that's where I would get my bag bomb, horse feed, those sorts of things.
Oh, okay.
Have you been to a Tractor Supply?
Yes, I have.
Where?
In suburban Maryland.
Do you remember how popular they were during the pandemic?
I do.
What was that?
I have no idea, Tim.
Okay, we'll move on. From Tractor Supply to rockets, I want to look at Rocket Lab Corporation, RKLB. US is the ticker. It's a space company. It's seen as an alternative to SpaceX for some things. It was up 9% today. This always moves, well, I don't want to say always, typically moves higher on days that you see Elon Musk and Donald Trump kind of go at it. Look, Rocket Lab is tiny compared to what SpaceX does and can only do a fraction of what SpaceX does. No question SpaceX is the market leader. But if investors are looking for companies that could be alternatives to some of what SpaceX does, they look at companies such as Rocket Lab, and that's why you have shares higher today by more than 9%. And Wolfspeed in the green today. This has been a decliner for quite some time, up more than 95% today. They filed for Chapter 11 bankruptcy late last month. They named a new CEO, Gregor Van Issum, as CFO and EVP, effective September 1st. He does succeed Kevin Spirits, who will return to his prior role of SVP for finance. Once again, shares of Wolfspeed up 95%.
All right, and looking at some of the decliners today, let's start with Tesla. That stock falling 7%, almost $70 billion of market cap wiped out in just one day. And this is coming on concerns that Elon Musk's move to form a new political party, a third party, will draw backlash from President Donald Trump. We saw analysts weighing in on this. William Blair downgraded the stock. They said they would prefer Musk to focus on the robo-taxi rollout. And the broker also noted that Trump's tax bill is set to cut demand for Tesla's emissions standards credits. So that stock down 7%, closing out the day. I'm also watching shares of Stellantis. U.S. shares of Stellantis fell as much as 5.7% as Bank of America cut the automaker to neutral from buy, with the broker expecting to see a, quote, very weak first half report on July 29th. And then additionally, the auto workers union warned that the company's Italian car production cratered by a third in the first half and is poised to sink further this year from multi-decade lows. Again, that Stellantis positioning in Europe doesn't look good, at least according to Bank of America, even though the U.S. appears strong. And then finally, Core Scientific, ticker CoreZ, shares were down 17% to close out the day. And this is after CoreWeave agreed to buy the company for $9 billion in an all-stock transaction. Now, analysts are positive on the deal for CoreWeave, but they said the negative reaction in the Core Scientific stock could reflect disappointment with the deal terms. And it really was disappointing. It fell as much as 24% and then pared those losses just a bit, but really down in the red today.
Yeah, phenomenal move in Core Scientific. They really kind of defied, at least on the surface, some degree of logic. Meanwhile, a lot more logic to be found in the Treasury space. You did see that Treasury curve re-steepen here with yields on the longer end of the curve up about 6 basis points on the 30-year, and on the 2-year yield, the shorter end of the curve, only up by about 2 basis points here. And a lot of this seems to be based on the idea of the longer-term risk, potential risk, perceived risk right now going on in the United States and the compensation that investors would demand to take on that risk.
You're talking about bond yields. I'm thinking about egg bites. At Starbucks.
At Starbucks.
You know Brian Niccol, former CEO of Chipotle.
Oh, yeah,
really turned that company around. He was at Yum Brands, did Taco Bell. Yeah, Newport Beach, right?
Yeah, absolutely.
So he did the Doritos Locos Taco. Not exactly health food.
Yeah.
But now they're trying to sort of make Starbucks healthier right now. And what he's doing is he's...
I don't like the sound of that.
Trying to take out canola oil from some of the products at Starbucks, from its food menu. What's wrong with canola oil, you ask?
Well, in June, Brian Niccol pledged in a meeting with U.S. Health and Human Services Secretary RFK Jr. to further align the chain's menu with the Trump administration's health priorities. So this move does seem to be
I'm sorry, what? The health priorities? So the priority is what? To kill off corn farmers? What? I'm sorry.
Maha.
To make the egg bites healthier, I guess.
Yeah.
Did they say what they're replacing it with? Oh,
avocado
yes.
oil.
Avocado oil.
Yeah. Here's the thing. Seed oils have a really bad rap, and they've increasingly had this bad rap, and it's become political.
Don't most of our avocados come from Mexico? Is that, does that dovetail
There's literally
with
a company
policies?
called that.
The only good thing about any of this is that you're used to already spending more than you'd like in any given day at Starbucks. So
right. I just do
the idea of it getting more expensive is just, another reality of the situation.
We should note in this piece that even though seed oils have this bad rap, there have been meta-analyses that have found that you're not likelier to die of cardiovascular disease, or it doesn't necessarily bring inflammation higher within the body if you do eat some of these seed oils, even though they are being targeted by Robert F. Kennedy.
What'd you have for breakfast this morning, Tim? Yogurt and fruit, let me guess.
Yeah, I did have some yogurt and fruit.
How about you,
It's
Chanel?
not fair. You walk by my desk and you see what I'm eating.
Yogurt and fruit. Emily, save us here. What'd you have for breakfast?
Yogurt and fruit.
Oh, no.
Anyway, all right. Speaking of
That's what
yogurt.
we serve at the office.
Okay, all right. Well, we got a bunch of healthy people here on the show, minus one. Did any of you get out this July 4th weekend and go to the movies?
No.
Okay, well, some people did, and they saw Jurassic World Rebirth, which I'm told is they're scrounging around. Look at that. Is that Scarlett Johansson there? Is Jonathan Bailey? A few other people in this movie trying to get the DNA from these dinosaurs so they can, I don't know. I haven't seen this movie, so I have no idea what happens next.
This is the 7th one, right?
I don't know. I've only seen the first one, believe it or not, which I think pretty much came out 57 years ago.
I've only seen the first one also. No, they came out like the 1990s. That was the first one.
I was a child. I know that much.
Yeah, I was as well. And I guess probably we're the only two people who've seen this movie, right?
Shanali, have you seen this movie?
I have not seen the first Jurassic Park. I will not see the last Jurassic Park.
You've not seen the first? What?
But I do appreciate ScarJo walking into it like she's about to step into Top Gun. So.
Well, it was a big box office hit, and I guess some people did find a way to just spend the weekend, as we often used to do in the past, in the old days. You know, spend the holiday weekend at the movie theater.
Yeah, I'll go see that movie. Who doesn't love a dinosaur? Pretty good showing for the weekend too. Hey, that is going to do it for our cross-platform coverage of the market close on Bloomberg TV, radio, YouTube, and Bloomberg Originals. We will all be back tomorrow, same time, same place.
And we continue our coverage here on Bloomberg Television with a close eye right now on the White House, President Donald Trump, and that self-imposed tariff deadline. We are expecting to hear from the president potentially in the next hour. We're going to have a conversation when we come back after the break about the potential market reaction to it all with Paul Christopher, head of global investment strategy at the Wells Fargo Investment Institute. This is Bloomberg.
The countdown is on. Everything you need to get the edge at the end of the market day. This is The Close.
Welcome back to The Close. I'm Shanali Basak.
And I'm Romaine Bostic. And Shanali, we talk about that massive rally we had off of those April lows. It took the markets to a record high. Well, a little bit of a breather from that. We got a taste of it at the end of last week, the holiday shortened week. But today it really reared its head as a reminder that tariffs are still in play. An S&P 500 down 0.8% here on the day. You saw a slight uptick in yields. The shorter end of the curve, not a whole lot of action, but about a 6 basis point rise on the long end of the curve. And remember, when we talk about tariffs and whatever's going on with that July 9th deadline is not necessarily just about the big nations. The BRICS countries having a summit earlier today, weighing in on the tariff issues, saying that basically they did not necessarily appreciate the U.S. approach to that. That prompted the president to take to social media saying, well, watch what you say. You saw a huge downdraft in EM currencies. In fact, one of the biggest declines on a daily basis for that index going back to November of last year. And at the bottom of your screen, you see industrial metals having their worst day going back to mid to late April. A big downdraft in copper, aluminum, other prices that are tied to a lot of those BRICS countries.
Yeah, I want to show you also, Romaine, some of the movers that had caught my eye throughout the course of the day. Tesla, of course, the political party in the U.S., the idea that Elon Musk wants to start a new one might put him at even greater odds with President Trump. And there are worries from investors that that's forming yet another distraction. Tesla was down more than 6.7% today, and you saw it, of course, increase its decline to roughly 27% on the year. I'm also watching CoreWeave and Core Scientific. CoreWeave down about 3.3%. Core Scientific down more than 17%. They agreed to a deal that would give Core Scientific investors roughly 10% of the combined company. Now, even though this is a massive M&A play in the world of AI, the attempt for both of them to combine here, investors of both companies met that deal announcement with negativity. But for CoreWeave, though, it does show the value of going public, which it did recently, because now, Romaine, it's using its stock as currency for acquisitions, decline or no decline.
Yeah, and absolutely. And despite the red on your screen there, that $9 billion deal has actually been part of a lot more activity that we've been seeing in the broader deal spaces, particularly as we start the second half of the year. It's adding to a big deal-making turnaround that really sort of took off in the second quarter, but a lot of questions still lingering right now about the landscape as attention now turns back to trade and the uncertainty that comes along with it, as well as returns with regards to the S&P 500. Paul Christopher joins us right now, head of global investment strategy at the Wells Fargo Investment Institute. And Paul, I do want to start off first with some of the optimism that we saw in financial markets kind of coming out of sort of mid-April, definitely deep into May and into June. This idea here that maybe the markets had positioned themselves for the idea that the worst case scenarios, whether it was on trade, the budget, conflicts in the Middle East, that all of that to a certain extent was in the rearview mirror. Was that misplaced?
Yeah, it certainly is misplaced. I'll say present tense is. The tariff part especially never made any sense to us to dismiss tariffs. Look, even if Trump makes a deal with some of these countries, the tariffs are going to be higher than they were before. And let's face it, 25% tariffs on South Korea and Japan, even if they don't end up being 25%, something lower than that, that's still going to be significant for many of the goods that we all buy every day.
The question, though, is, Paul, and I know we don't exactly know what the final rates are going to be, but if they are at the higher end of the scale of what Trump had alluded to a couple of months ago, has any of that truly been priced in? I'm talking about the potential effect on corporate bottom lines, the potential effect on consumer spending and economic activity.
No, not priced in, we think, and for a couple of reasons. First of all, you had a very large buildup in inventories, both at the wholesale and the retail level, late last year and into the winter months of this year. That inventory is still being sold off. So that inventory comes in at pre-tariff prices. We're not going to notice any real difference. And that may have been part of what has fooled many people about this tariff program and thinking, oh, well, it's been announced, but we're still buying goods that were brought in at much cheaper prices pre-tariff. And the second real problem here is that, companies haven't really decided yet how they're going to manage these tariffs. In some cases, they will be passed through. In other cases, they may be able to foist those tariffs back on the factory from where they're buying. Maybe it's in South Korea, maybe it's in China, maybe it's in Cambodia. Some of those prices will go back to the factory. Some of them will be eaten in terms of the company's cost structure, and some of them will be passed along. We're not sure yet. Nobody can be sure really what percentage that will be. It just depends on the final levels of the tariffs, which don't seem yet to be set. And so there's still quite a bit of uncertainty about tariff policy. We've been promised by the Treasury Secretary that the tariff policy will be set by September. Maybe that was another piece of optimism that this wouldn't go on indefinitely.
And that's country specific tariffs that we're talking about here. What about Section 232, right? I mean, if you think about what is left still in the tariff strategy, there's a fair bit that is still en route, isn't there? Do you think that the market is starting to misprice what's possible?
You're exactly right. It's as though people have completely forgot about 232 tariffs. Those are sectoral tariffs, and pharmaceuticals, base metals are out there right now, and semiconductors possibly also, maybe with some exceptions, but we're not clear yet on what those will be. So you're absolutely right. Sectoral tariffs are in the background yet.
Paul, the other thing about this is that the market is still pricing in roughly 2 rate cuts this year. There are a number of investors that say, okay, we don't necessarily see inflation roaring back by any means, even with these new tariff rates that are being discussed. But what is the likelihood that the Fed really does have room to cut at all, let alone how much the president wants it to be cut?
Yeah, we've seen markets start to price in additional rate cuts. We were 2 last month. Now we're at 2.5. That's another way of saying 50-50 odds maybe on 3 rate cuts. That's as that number of rate cuts has come down, the market has been better for the dollar. But going forward, if we do see these tariffs come in, even if they're spread out a little bit more than they look like they would be in April, we're still going to get a bump in prices. So that's what the Fed is waiting for. They want to see how much that bump is going to be. And it's probably going to start to arrive right around the time most of us are doing our back to school shopping. So late August into September, October, that's when you're going to see the bump. So we don't look for the Fed to cut before then.
Real quickly here, Paul, there's a big question right now for investors, those invested in this market and those maybe looking for entry points, as to how you allocate in this situation. That if you want to be a part of this market and you are concerned about tariff risk and budget risk and geopolitical risk, do you as one of our previous guests said earlier on the show, do you overweight fixed income? Do you look for defensive stocks? What do you do?
Well, we would definitely be careful in both areas. In fixed income, we're going to see, we think, the most volatility in price around the long end of the maturity spectrum, the yield curve. So we would stick with those maturities, investment grade, corporates and municipals, yes, 3 to 7 years of maturity. Longer than that, and you're going to get whipsawed as these tariffs push inflation around up and down. And then on the equity side, what you want to try to do is invest for the longer term, especially if you're already a long-term investor to begin with. Don't get yanked around by these markets. So we've liked tech and we've liked communication services here. They're starting to get a little bit pricey. Maybe it's time to take a different angle on tech, maybe the energy angle. Energy as a sector and utilities as a sector. We like both of those as an adjunct way, let's call it, to play tech that's still cheaper. Because what you really want to do is buy that trend in artificial intelligence, but at lower prices as possible. We think, another thing you could do would be to take some money off the top. If you're already invested in tech, take some money off the top, put that to the side. We think you will get a pullback 5 to 10% in this market maybe. That would be a time to put some of that money back to work, either in tech, comm services, or energy, or utilities.
Paul, the market has certainly agreed with you today. That is Paul Christopher. He is head of global investment strategy at Wells Fargo Investment Institute. We appreciate your time. Now, coming up later this hour, Randy Schwimmer, vice chairman of Churchill Capital, joins the show to discuss his M&A outlook for the second half of the year. This is The Close on Bloomberg. Now, the deadly floods in Texas raising questions around federal, state, and local officials' preparedness for severe weather events. President Trump planning to travel to Texas later this week to survey the damage firsthand. We're joined now by Alan Gerard. He's the CEO of Balanced Weather and formerly holding leadership positions within the NOAA's National Severe Storms Laboratory. When you look at what had happened in Texas, devastating floods, the deaths exceeding 90, should there have been something different that officials were doing to alert the people in the course of the storm?
Well, I mean, to me, the first place to start is with the understanding that this really was unfortunately, a worst case scenario as it developed. You had thunderstorms move repeatedly over the same area, this particularly vulnerable South Fork of the Guadalupe River, for 3 to 4 hours, and produced just incredible amounts of rain in an area that is very flood prone. This region is known as Flash Flood Alley, the hill country of Texas, and there have been catastrophic flash floods on this river in the past. So it was definitely very difficult to anticipate more than a few hours, really before the rain started. It would be difficult to anticipate that this particular area was going to have such a catastrophic event. But we certainly would encourage people that are in these kind of, particularly flood-prone areas, whether you're talking about individual people or, businesses like campgrounds and stuff, to have multiple ways to receive warnings so that they can act when there's just a devastating event like this.
I am curious, and we should just point out, too, of course, as they still search for people and try to start the cleanup there, we are expecting more rain, more heavy rains in that area over the next 24 hours. It raises a question, though, too, Alan. I mean, as someone who understands how these weather patterns unfold, there have been a lot of talk about the drought that was affecting this area prior to that and how that may have actually made this worse. Explain that in layman's terms.
Essentially, the soil type in this part of the country is such that when it's dried out by drought, it almost kind of acts like concrete. It becomes very hard and impermeable. So when you get these sudden summer thunderstorms on top of this soil type, the water just runs off like it does in urban areas. And so that just exacerbates how much water actually gets into the river itself, and is part of the reason why you get these, these massive flood waves on these rivers in the hill country.
I don't want to divert too much attention away from the loss of human life and the tragedy, but I am curious to get your thoughts. Having worked at NOAA and seeing the budget cuts that have taken place over the last few months, not just at NOAA, but at other programs that are designed to monitor hurricanes, monitor weather and patterns, especially now that we are in hurricane season or getting into the heart of hurricane season. I am curious as to whether the United States, in your view, is going to be prepared for future weather patterns of this type of severity.
Well, I mean, it does appear like the Weather Service was able to provide the warnings and forecasts that one would typically expect for this kind of an event over the weekend. But having said that, there are a number of offices around the country that are significantly challenged as far as staffing because of some of the buyouts and firings that occurred earlier this year. So I'm definitely very concerned that as we go on through the summer, through the hurricane season, that the Weather Service is going to continue to be increasingly stressed. And, you know, we don't know exactly how much impact that might have had on this event, but it's certainly a problem for future events.
All right, Alan, we're going to have to leave it there. Alan Gerard is the CEO of Balanced Weather and has been a meteorologist for more than 3 decades as we continue to keep a close watch here on the conditions in Texas and, of course, the recovery process for both the loss of life and the loss of property. This is Bloomberg. All right, tariff pressures and political uncertainty prompting a shift in allocation. That's according to a new survey from Churchill Capital. Sectors like business services, utilities, tech, and financial services appear more resilient in the current economic climate. Here to talk a little bit more about that report and the outlook for the rest of the year is Randy Schwimmer. He's vice chairman of Churchill Asset Management, overseeing the Investor Solutions Group. Randy, great to see you here.
Great to see you again.
I would just want to go back maybe just a few weeks, because we did see a pretty significant uptick in deal-making activity. And I was actually kind of surprised when I was looking at kind of the aggregate numbers for the first half. I mean, we're actually tracing above where we were for that same period in 2024, both in terms of deal volume as well as the actual values. Now, I know we're not back to kind of the heyday of 2021 and where we were, but does that give you some hope that maybe the second half of the year is going to be pretty good?
Well, the timing on this survey was great. As you know, the way our strategy works is we're an investor in our client funds, as well as being a financier of the middle market companies. And what we're focused on for the most part is those funds where we're an investor. We're in an LP in about 400 different GPs. And the beauty of having a survey with those clients is that they're telling you, like real time, what's going on the ground. The middle market, Romain, is very different than the broadly syndicated market, than the large cap M&A market, because these private equity firms are focused on strategies that are kind of embedded in specialty areas where they have an edge, an angle, something that over decades their operating partners have developed. And in many cases, these are US-centric companies, medium-sized businesses, in business services such as, for example, accounting firms. Now, the accounting firm industry is consolidating, kind of like the banking industry, and you're starting to see the need for bigger, more scaled businesses. And so private equity sees this as just another example of being able to take regional businesses, grow them, and then sell them and create capabilities along the way. Another perfect example, I think I mentioned this to you before, is commercial landscaping. During COVID, empty buildings, but they still had to, somebody had to mow the lawn, shovel the snow. And my favorite now is pest control firms. So who doesn't care about Fed rate hikes? Ants and termites, right? And so as a result of these kinds of businesses that are US-centric, they're small, they don't, like today's news on tariffs, there's no impact on those kinds of businesses. So we're seeing more flow from private equity firms that we're dealing with in these kinds of very sort of deep middle market sectors, and that's why the pipeline, our pipeline in particular, is growing quickly.
Well, I'm curious. It's interesting you say that, and I like the examples you give, because we talk about companies that to a certain extent might be a little bit insulated from some of the noise that's going on out in the world today, but also companies that to a certain extent might actually have certain markets, if not all to themselves, certainly close to it. But it does raise the question that when you hear the noise, whether it's tariffs or the budget bill and all the other things coming out of Washington, Does that create any worry in your world at all?
It creates a lot of noise. And one of the beauties of being on your program and being on with Tom and Paul on the radio is that we get to tell our story about what's actually going on in private credit. So today, July 7th, back in 1980 is when I first started my career in private credit. And one of the things I learned about dealing with medium-sized companies is they operate sort of below radar in a lot of cases. And while in those days it wasn't viewed as really attractive because they weren't being able to access the large markets, they couldn't go public, they couldn't access the bond market. Today, that's considered actually to be a positive for investors because these companies are sheltered from the kinds of macro issues that we've been seeing in spades. I mean, whether it's tariff or trade or the geopolitical risks that we've been seeing, and even with rates. I mean, we have seen most of these companies are high free cash flow companies. They're leaders in their businesses, and they tend to be, because they're private equity backed, at a growth pace that's higher than the sort of average GDP company. And so all of these benefits are now kind of flowing together on behalf of investors, which is why it's so popular.
I am curious, though, but on the deal front, I mean, because there was always this idea that those types of companies needed an exit path, either to an IPO or to be bought. And we have seen a lot of M&A activity where a public company is buying a private company, or in some cases, seeing two private companies combine. When we use the phrase exit path or whatever iteration of that, is that sort of a misnomer? Is that sort of the wrong way to look at it with these types of companies?
Yeah, what's interesting about the survey is that, and this is why the second quarter numbers was so helpful, is that our clients were saying that the exits they were expecting over the next 12 months were increasing. So I think it was 90% expected 2 or more exits this year, the next 12 months, and 3 more exits for about a third of our private equity clients. So that means that the pace is accelerating, in part because I think that people are recognizing the benefits of some of these, again, companies that are below the radar screen, companies that are more resilient no matter what happens with rates or tariffs, and companies that have higher growth paths. And so what's interesting for us as private credit investors is that the purchase price multiples remain for these businesses actually higher than they were in 2021. Because over the 4 years that we've seen these companies perform, the buyers are saying, oh my goodness, these companies are really resilient and I'm willing to pay more. Now, as a private credit investor, we have a lot of equity below us, therefore, and our average loan to value in the deals we're seeing is about 35%, which is very attractive.
I'm curious for new deals or even just trying to value your existing deals, and I think I posed this question to your partner a few weeks ago, Ken Kinsell, this idea of price discovery and how reliable that is in this environment, because even though I know these companies to a certain extent are somewhat insulated from some of these issues, but the noise out there certainly has an impact on investor sentiment. So whether you're talking about at the GP level or at the LP level, there certainly has to be some concerns about what I'm buying and am I buying at the right price?
Yeah, well, that's the beautiful part about dealing with private equity firms that have 20-year, 30-year track records as great investors. And they, in many cases, have operating partners that have identified these businesses not just because it looks attractive, but because they've actually got a relationship with the C-suite at many companies within that niche and have developed over time a thesis, an angle, an edge where they believe that they can invest in a way that is more attractive than, for example, a competitive business. So they've analyzed the upside and downsides of these companies in a way that provides them with real sense of certainty that price is going to hold off over the long run.
Only about a minute left, but I'm curious, as you look forward, I mean, not just the next 6 months, but really over the next a couple of years here, is there something, sort of that one big thing that you really have your eye on that could actually be a game changer, not just for your business, but really overall for the markets?
Well, I think what we're seeing right now is the fact that the public markets are good when everything is in line. So we saw in 2022 and 2023, when that didn't happen, public markets sort of fell back. What we've seen is that the private markets are there regardless of some of these issues. So while we don't know exactly what's going to happen over the next several years, what are some of the pitfalls, what are some of the trapdoors that we can encounter, we're pretty confident that no matter what it is, we're going to fare better than the public markets and being there consistently through whatever cycle gets thrown at us.
All right. Well, it's interesting. I mean, you talk about starting your career in 1980 or whatever
45
it was,
years.
But it's hard to believe. You don't look a day over 40. Anyway, it's been quite the evolution for your business and for private credit and private capital overall, and of course the relationship with public markets. Randy Schwimmer is vice chairman of Churchill Asset management. All right, the markets did close down here on the day, and that was largely because of concerns here about those trade deals or the lack thereof and the tariffs that could be imposed, if not on July 9th, certainly on August 1st, with the president extending some reprieve for certain nations here, but some big questions about all of the others. Those 90 trade deals in 90 days, not looking like it's going to happen within the next 24 to 36 hours, and you see the market reaction there on your screen. This is the close on Bloomberg. All right, time now for a look back at this day in history. 8 years ago today, when Tesla's first mass-produced car, the Model 3, rolled off the assembly line. It was the culmination of years of effort to take the Tesla EV platform that gave us the $100,000 Roadster, the $80,000 Model X, and the $60,000 Model S, and use that platform to create a more affordable car with better economies of scale. Now, the rollout of the sub-$40,000 Model 3 started slow, with about 10,000 produced in the first quarter of 2018. But that number would triple the next quarter and continue to rise, eventually making the Model 3 the first ever EV to sell more than 1 million units total. But annual sales peaked in 2023 at just under 600,000, a number projected by analysts to dip for a second straight year in 2025 to 533,000. While there are indeed a myriad of reasons contributing to the sales slump, including increased competition, most investors, they point the finger squarely at Elon Musk himself. They've complained about a lack of focus, a lack of leadership as he juggles his roles at multiple business ventures. And they've complained about Musk's foray into divisive political theater with his 2022 reshaping of Twitter and his 2024 financing of Donald Trump's presidential election victory. Now, Tesla as a car brand is still popular, to be sure, but its dominance has faded. Its market share for EVs falling from more than 75% 3 years ago to less than 50% today. Tesla sales globally, they were down 13% in the first quarter, another 13% in the second. And Musk, well, he's been trying to do some damage control, pulling back from his role in the Trump administration and promising to devote, quote, far more time to Tesla. But that promise is now being doubted after Musk announced over the weekend that he's spearheading a new U.S. political party that will immediately target House and Senate seats. That's not what investors in Tesla wanted to hear at all. The shares, which had already declined 22% this year through last week, slid an additional 7% today amid renewed questions about to what degree Musk's personal brand of politicking will continue to hurt Tesla's corporate brand image. Now, investors holding Musk to his vow to devote far more of his time to Tesla after he parted ways with the administration. Our next guest, he actually argues maybe some CEOs should actually be a little bit more hands-on when it comes to politics. Gautam Mukunda is Bloomberg opinion columnist, and more importantly, he's a lecturer of management practice at the Yale School of Management and has wrote one of the definitive books on corporate leadership. Great to have you here.
Great to be here, Ryan.
Of course, a lot of questions right now about what the leadership of Tesla is, and more importantly, what it should be, and the idea of whether CEOs should be mixing their own personal political projects with their business projects.
Right. So what I said is CEOs need to be more knowledgeable about politics. Right. And there is a big difference there.
Okay.
There's a long history of CEOs being involved deeply in politics in lots and lots of different ways. You have sort of very big institutions that were created just for that. But when CEOs make themselves the political story, they're, especially in this time, they're going to make half the country enemies. And if they do it the way Elon Musk has done it, they're going to make everyone in the country their enemy, which is not good. So he needs knowing more and speaking less was sort of the advice that I would give him right now.
What's the advantage? This might be a dumb question, but what's the advantage of knowing more about politics? Why?
Governments are intervening in markets and acting in ways that they have not historically in generations. So American business people in particular have a set of reflexes about the way the U.S. government will act within very normal bounds. Those reflexes are all taking you astray right now. They're all just wrong. They're not accurate. And that's true for other governments too, right? We're seeing major wars in Europe, major wars in the Middle East. If you are deeply sophisticated about politics, you could know a lot more about that. You might have some ability to see around corners that a normal CEO who just figures the politicians will do their thing just won't have.
But then there's, I guess, the balance that you have to have of not actually getting involved in that. Some would look at someone like Elon Musk and say, I mean, if anyone could see around corners, I mean, given that his perch in the White House and on the Trump campaign, he would know exactly what was coming around the corner. But of course, he inserted himself in a lot of things that, at least for certain consumers of his, they were not necessarily on board with.
Yeah, I think what we saw with Doge was Elon Musk plunged deeply into politics without doing a lot of sort of the background reading, is the way I would put it, right? That it turns out that a lot of these institutions are, in fact, pretty delicate and take a lot of deep technical knowledge to manage. And if you bring in people who are 23 and ask them to fire people based on AI and keyword searches, things are going to go wrong. Musk's track record of success in lots of places, right? It's not portable. You can't say just because I've succeeded in area X, that means I can succeed in area Y. You've got to do the work and build the base of knowledge. And he seemed to plunge in without doing that.
With regards, though, to just being politically aware, there's awareness of long-term structural changes. Yeah. There's also awareness of a lot of the short-term things, which some people would dismiss as noise. And I would assume, I don't know, you tell me your opinion, but I would assume that you don't necessarily want your CEO reacting to the short-term noise, or do you?
So only someone who has sort of a deep knowledge of the field is going to be able to tell you what's the noise and what's the signal. And so just as we'd never hire a CEO who said, well, I don't really know what's happening in the markets and I don't care and I don't pay attention. Well, for 3 generations, that was fine if you said that about politics, if you're an American CEO. It's just not fine anymore. The world has changed and we need to catch up to it.
I'm going to ask you kind of a loaded question, but it's the idea that particularly in this particular environment, given, and we're primarily talking about the U.S. here, given the way this White House works, isn't there an advantage to maybe being more active in politics for certain CEOs?
Yeah, you've clearly derived. There are CEOs who've clearly derived significant benefits from that, and in the at least in the short term, and maybe in the long term, depending on how politics plays out, that could be very rewarding for some companies. But you're definitely upping your risk. There's a very, very long list of people who thought that they could work closely with Donald Trump and manage Donald Trump, who Trump has turned on. And what Elon Musk has learned in the last few weeks is something that I think, again, someone who's deep in politics could have told them. If you are the richest, most powerful business person in the world, which he definitely is, you're still a pygmy compared to the President of the United States.
When you look at the CEO slate out there now, and really, and even go back to the first Trump administration and the CEO slate then, is there anyone that stands out to you that maybe did it right, that found a way to sort of navigate the somewhat volatile politics without necessarily upsetting the president, at the same time not necessarily upsetting their consumers and investors?
The easiest answer is Jamie Dimon. He understands politics at a level of sophistication that very few people, even in the financial sector, but just broadly do. And even when he puts a foot wrong, which everybody does once in a while, he's built up such a reputation and such credibility that he can get out of that problem relatively easily. I mean, it's the cliched answer, but there's a reason it's the cliche. It's because it's usually right.
Yeah, he's usually right. I think some people might put Tim Cook in that basket as well, although things are a little shaky nowadays. Go back in history, though, because, again, we talk about this idea in politics, and I think back to the CEOs that kind of came out of the Industrial Revolution, obviously the big titans, whether it's, the Carnegies or the J.P. Morgans, speaking of Jamie Dimon, they were political animals.
They were.
In a lot of ways. And somehow it worked for them. I don't know if maybe it worked for them because they were monopolists, but all joking aside, it did seem like there was an era of CEOs in this country where they were, maybe by mandate, just by the nature of what was going on in the world, they had to be very politically active.
So they did, but step back, right? So if you go back to the Theodore Roosevelt administration, like the early 1900s, the president of the United States was first among equals among American leaders. He wasn't the dominant figure that you see the president as today. That is a creation, in fact, of Theodore Roosevelt. And so famously, when he started doing antitrust investigations of J.P. Morgan, Morgan sent him a note and said, if you have a problem with what I'm doing, send your man to my man and they'll work it out together. By your man, he meant the Attorney General. So in Morgan's view, he was a peer of the president, and his corporate counsel was a peer to the Attorney General. And a big part of what Theodore Roosevelt did was establish that that was not true.
And I think we're kind of maybe getting a repeat of that now with the current, but to a much different extreme here. Gautam, we have to leave it there. Really great stuff, and we have to get you back on for a longer conversation about this. Gautam Mukunda is a lecturer of management practice at the Yale School of Management. He's also a Bloomberg opinion columnist. All right, stick with us. We're going to set you up for it to watch when we come back. This is Bloomberg. All right, well, Amazon's Prime Day is kicking off tomorrow with the event extending through Friday. Poonam Goyal, senior analyst over at Bloomberg Intelligence, is writing that Prime Day appears poised to drive record sales by embracing deep discounts, AI-powered shopping tools, and core benefits like fast delivery. Poonam joins us right now to talk a little bit more about Amazon Prime Days, plural. It's been plural for a while now, Poonam, and I am curious about the idea of exactly what Amazon is going to be pushing. Is this just basically about slashing prices, real discounts?
It's about giving people deals. Consumers want deals today, especially as they're worried about price hikes across retail. So I think extending it from 2 days to 4 days just gives them an opportunity to give specific deals every day. So targeting, let's say, electronics one day, household another day, beauty another day. They're trying to be more strategic and span out the deals over a 4-day period versus a 2-day period.
How did that work in the past? So like when they first started this, I forgot how many years ago it was, the idea was that it was 1 day, you basically had to get in, then they kind of moved it to 2 days, and then I think at one point they have 2 separate Prime Days throughout the year. Is that a strategy that has actually worked for them?
Yeah, I mean, look, when they went from 1 day to 2 days, it was bigger, it was better. They went from 2 to 4. We expect it to be bigger and better. You have to remember that Prime Day has now become a shopping event, not just for Amazon, but for the retailers that it competes with. So you see deals out from Walmart, from Target, from Dick's Sporting Goods, and really a lot of other retailers that span their deals beyond the 1 or 2 days that Amazon used to do it at. It's all week. So why is Amazon giving up that share? Why not compete for the longer period of time?
You've been covering this company for a long time, and we're speaking on a day where a lot of people are concerned about the threat of tariffs. And anyone who's been on Amazon's website knows that there are a lot of products here originating from China and other nations outside the United States. Is there a material impact, in your view, longer term, assuming these tariffs do go into place, that Amazon would be affected, that its business model would be affected on the retail side?
Yeah, so when you look at Amazon's business model, you really need to split it up into 2 halves. One is its first-party business, which is where Amazon houses its own products and sells it. That business is impacted, but then I would bring you to the point that, yes, it's impacted, but Amazon has 2 other sizable businesses that it can get profits from to offset any losses there, the AWS and the advertising business. The third-party business, which is largely third-party sellers, and many of them, yes, from China, is going to be impacted. But there, Amazon shares the pain, right? It's the third-party sellers that will probably bear the brunt of that pain, and hopefully the mix will change and evolve over time, but there is more impact there.
Real quickly, only 30 seconds, Poonam, but you're seeing a big drop in the after-hours trade in Gap, Lululemon. Do those companies, do they have the ability to weather that storm?
It's much harder. You know, when you talk about Lululemon, they produce a lot of what they sell in Vietnam, and we just heard last week the Vietnam tariffs will be going from the 10% to 20% possibly. That's a big dent. It is going to be harder to offset those costs, and prices will have to rise more materially than we expected.
Poonam Goyal over at Bloomberg Intelligence as we set you up for what to watch over the next 24 hours. That includes Amazon's Prime Day annual sales event. Also, we're going to get some economic data at 6 a.m. The NFIB Small Business Optimism Index. That could be a big read here on what comes next. Also, overseas, keep an eye on French President Emmanuel Macron, his first state visit to the UK, and also keep an eye on top diplomats from the U.S., China, and Russia expected to meet in Kuala Lumpur. This is Bloomberg.